Good evening, traders and investors. Will back here with another one, coming to you with a Tuesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, well, the SPY and the QQQ were largely flat on the day, which might lead you to believe that there wasn't much action in the markets today, but there was actually a ton of action in the markets today. And there's a very big rotation underway in the markets that not many people are talking about, but maybe became very apparent today. And we're talking, of course, about the rotation from all of the high-flying AI infrastructure names. Both energy plays like SMR and Oklo down absolutely tremendously in the past week of trade. The critical minerals narrative trade, that one is unwinding too. Names like MP Materials down 25%. Other big players in the space down 39% on USAR, and on UUU, that one as well. Quadruple U's down 24%. Then, of course, you have the neo cloud providers. APLD coming off its high 18%. Iris Energy, this one down 25% from its high, and the list goes on. You can go down to some of the other high-flying names like ASTS. Clear big unwind on this chart right there. Names like NBIS as well, suffering the same fate, down about 27% from recent highs. So it raises the question, where's the money actually going into? Well, it's one piece of the market, well, several pieces of the market, but one specific piece of the market is getting a little bit more attention than it has been in the past 4 or 5 months. And that, of course, is software. Take a look at Adobe today. Adobe up 4% in the last 3 days from the lows. I know it's not much, but that's a 10% move. Take a look at CRM, Salesforce as well. From the lows just a few days ago, this one is up 12%. And the action continues when you take a look at names like Monday.com, up also about 10% from its lows. ServiceNow catching a little bit of a bid from its recent lows, up about 6%. So a lot of the software players, even some of the cybersecurity names, performing really well recently. So you have a big rotation here for some of the high-flying names into some of the less loved parts of the whole AI narrative, of course, right? So that was a very big rotation today. We also had other news, not in terms of macroeconomic news, but other news in terms of big tech. This piece of headline right here did damage to Google throughout the day. OpenAI launching their new Atlas browser to compete with Google Chrome. After that news was released, Google stock went down almost 4% before getting half of that back. And you might notice right now, Google is actually up in the after hours 2.4% because they got another piece of news, which was bullish for them in the after hours. And that piece of news was the following. Anthropic and Google in talks on cloud deal worth tens of billions. I'll remind you, Google actually invested $1 billion into Anthropic earlier this year. But that doesn't leave everybody happy. You can see here that Amazon stock is down 1.5% in the after hours. So Anthropic is actually Amazon's main partner. So as a result, you're having a little bit of competition here between some of the big tech players. Google was big down today, and now in the after hours, ending up green. Amazon was big green today. Now in the after hours, going down. So you got a lot of push and pull in the markets overall today. Couple that with a whole bunch of earnings, and you ended up with a very action-packed day in the markets, which is something that the indexes are not showing right now. So in today's video, guys, we're going to unpack everything, of course. Number one, we'll be going through these pieces of news and just deriving some potential conclusions from them. Talking about this deal, and of course, this deal with Anthropic and Google. Thereafter, we will take a look at 3 corporate earnings that I've prepared for you guys today. We're going to be taking a look at Coca-Cola for an insight into the consumer. Always important to check on those consumer dynamics, especially in this market. Thereafter, we'll take a look at Netflix, of course, the big one of the bunch, down about 6% in the after hours right now. And lastly, we'll take a look at Texas Instruments. Now, special shout out to ISRG, which is up like 17% in the after hours right now. Maybe I'll cover this one at a later time. GE was also interesting. Lockheed Martin and some of the other defense corporations were also interesting today, but the focus of our analysis will be on these 3 companies for today. And of course, tomorrow, we got a lot of stuff to unpack from the Tesla earnings too. So we'll cover those 3 company earnings, and thereafter, we will get into our overall market rundown and focus on rotation. We'll take a look at the indexes, see where the rotation is and is not. Thereafter, we will do the same thing across our big tech list down across the board, see where there's some good swing trade opportunities or possibly some long-term portfolio opportunities too. And at the very end of the video, yes, I'll be taking you guys through the biggest gainers and losers of the day. Of course, there were many big losers, and there's a common theme between them. which we described earlier in the introduction. And of course, we'll take a look at some of the companies printing on the highs today and derive whether or not there's some swing trade opportunities there as well. And that'll be it for today's video, guys. I did do a whole bunch of swing trades today and other wheel trades. If we have time at the end of the video, I'll show them to you. If not, it will have to wait to the Friday session where we usually do the second part of our position recap, once on Monday and then once on Friday. We had a good day of trading today in the portfolio, lots of action. So let's jump right into today's video, shall we? The SPY pretty much flat on the day. The Q's down 0.03%. Take a look at the heat map, and it's kind of all over the place. Big tech companies mixed all over the place. Several semiconductors coming down, others rallying. Software, though, software as a service. A lot of these names having a very good day, led to the upside by CRM, Adobe, and even a company like ServiceNow. Financials kind of mixed. The insurance players, some of them down. Some of the investment banks down, the big banks down as well. No news, just rotation within the sector. The credit card players had a really good day today. Healthcare remains a little bit of a mixed bag, although the ETF did end up higher today. Not all aspects of that market were performing the same. And the bottom half of the market as well, very mixed. So today's the type of day that, depending on what you were invested in, you were either big red or possibly big green. Very confusing day in the market after yesterday's big day of green market breadth. On the one-day relative, you can see that even better, to where only a few sectors made it out of today alive. Consumer cyclicals and industrials, to be specific. Healthcare was roughly mixed, and technology slight bias to the downside there, which leaves you on a 1 week relative to where the market is pretty much mixed, right? About half the sectors, maybe a touch more than half, are still in the green territory, and to the downside, basic materials, financials, and utilities, unfortunately. So the market still remains somewhat balanced and more broad than it was roughly a week ago, but you can still see that some sectors have a little bit of pain in terms of their performance mix, right? So before we get into more technical analysis for the markets, let's do a quick little recap of our news headlines. So here you go. OpenAI launching the Atlas browser to compete with Google Chrome. OpenAI said Atlas launches Tuesday on Apple laptops and will later come to Microsoft's Windows, Apple iOS phone operating systems, and even Google's Android phone systems later on. Moving on further here, here's what Sam Altman had to say. Altman said he expects a chatbot interface to replace a traditional browser's URL bar as the center of how he hopes people will use the internet in the future. Tabs were great, he said, but we haven't seen a lot of browser innovation since then. A premium feature of the ChatGPT Atlas browser is an agent mode that accesses the laptop and effectively clicks around the internet on the person's behalf, armed with the user's browser history and what they're seeking to learn, and explaining its process as it searches. That's kind of weird, but still, I guess we're making progress technologically speaking. It's using the internet for you, concluded Sam Altman. And we have a few highlights here from the new OpenAI browser, so we'll just go through a few of them here. So obviously, they're going to replace the chat bar with a little bit of ChatGPT action right there. Locking the web with ChatGPT by your side. So here we have VRBO, which is kind of like Airbnb. I guess they didn't want to feature Airbnb. Are there good hikes nearby? See, there's a little browser integration that you can kind of, whatever you're looking at on the website, ChatGPT will figure it out and kind of derive possible things for you. More things as well, right? When you're on airline tickets, is there a mother's room at my connection? Is it open when I'm there? Very decent integrations, right? Assisting where you need it, talking about emails, of course, picks up where you left off. I mean, I'm pretty sure we already have that, but here you go. Open the Halloween decorations I was looking at in some tabs last week. You know, bit of a faster interaction there. I mean, everybody has tab history, so you can go look. Heading to the beach tomorrow. This is an interesting one with Instacart. Heading to the beach with the kids tomorrow. Can you grab the usual beach day stuff? This is interesting. This is the agent version of the website, right? The agentic version where it kind of does some shopping for you. The usual, got it. I'll grab the well-rated SPF 50 for the kids, the snacks they love, a few extra supplies. Would you like me to use your browser to work on this? So you will have to input some final confirmations, but at least it uses your browser history or purchase history, all for the benefit of you and productivity and efficiency, of course. So some very interesting things in the OpenAI browser. Obviously, Google has 3 billion plus users, so the death of Google Chrome will not be something that happens overnight, but nice to see a new challenger. But, you know, the overall argument here is this going to be commoditized? Is Google just going to be able to do the exact same thing with their Gemini AI agent integration? Is Microsoft going to be able to do the exact same thing with its Bing browser? and so on and so forth. Is Apple, I know, I can't even begin to say this, but let's just say Apple figures out AI sometime between now and 2050. Is Apple going to be able to integrate something like this in their Safari browser? Who knows? But one thing's for sure, right? You would tend to make the argument that it will probably be more commoditized to where a lot of the individual browsers might just have their own thing, which kind of forgoes the need for everybody to pivot to ChatGPT. But obviously, it's going to be an open-ended discussion. We don't have all the data just yet. I guess we'll just have to wait. That's piece of news number one. Piece of news number two, this big deal, Anthropic, Google in talks on cloud deal worth tens of billions, looking to provide Anthropic with a lot of cloud compute power. So you can see the headline down here. Let me move myself over. Anthropic's in discussions with Google about a deal that would provide the AI company with additional computing power valued in the high tens of billions of dollars, according to people familiar with the matter. So that's going to be an extra source of revenue for Google, of course, which is pretty good. And I'll remind you, Anthropic recently closed a $13 billion funding round, has received investments from Google, Amazon, and other firms to advance its AI capabilities. But this was Amazon's main partner, which is why Amazon is down in the after hours right now. I mean, I'm pretty sure there's enough of Anthropic to go around between Google and Amazon, of course, but Anthropic was really supposed to accelerate some gains in AWS, which is why you're probably seeing the Amazon share price get hit a little bit in the after hours. I think it's not going to be too big of a deal for the business, of course, but the news headline is going to hit on the same day, of course. That's pretty much everything that we had for our news recaps. I'll remind you, we don't really have much in terms of macro news for the rest of the week until Friday, where you get the big bad CPI report showing a 3.1% increase year over year. That's in relation to the 2.9% we got not too long ago, about a month ago at this point. But if you don't believe the headline numbers, well, you might believe the Trueflation Index numbers. Those are still very poised here at about 2.25, which is in line, roughly in line with the Fed's longer-term target on inflation. This one is better, in my opinion, because they measure 15 million different price points for different products on a daily refreshed basis. So it's obviously a more extensive basket than the CPI. However, the markets will move on that CPI print. So we're going to be curious to see what we actually get on the Friday session. And in terms of rates, well, the probabilities for a rate cut next week, by the way, next week's going to be huge. All the big tech earnings. And we get Jerome Powell with a 99% probability of an interest rate cut of 0.25%. And then we probably have another one coming in the month of December, 99% probabilities for that one as well. So interesting day in the markets. That being said, let's jump into even more interesting stuff in terms of earnings. We're going to start off with a very big one. We will start it off with good old Netflix. Netflix is down almost 6.25% in the after hours right now. What exactly happened? Well, they set the stage for beats upon beats upon beats. If you go back to these quarters, guys, massive beats, massive beats, massive beats. See a little bit of red right here because they missed. They missed on EPS, but it's not what you think. Their profits aren't getting squeezed by, internal factors to the company. Something else happened, and we'll talk about it. EPS down about 15.6%. They missed on operating margins as well. They did beat on revenue, though, by $1.88 million, which wasn't a substantial beat, but the bar is very high for Netflix, of course. The stock has ran a tremendous amount this entire year so far. It's been one of the best performers of the entire S&P 500. The stock is still up almost 40% year to date. Now, obviously, it's going to be less than that, but the bar was very high for Netflix, so the report needed to be absolutely perfect, and unfortunately, it was not. Let's take a look at the easy numbers for Netflix real quick. Revenue was up 17% year over year, which was fantastic. Asia Pacific revenue, 21%, very good. Operating income, here was the problem, guys. 12% year over year, which was still good, but you can tell what happened here with the drop in operating margins, and we are going to explain why in just a few short minutes. EPS was up 9% year over year. Moving on to some of the numbers here. What happened specifically to the numbers? So you can see here that they beat on revenue, small, but the big miss on EPS overshadows that. Free cash flow was very good, but the guidance, guys, revenue came in good, EPS came in good. What Wall Street didn't like is operating income and operating margins for Q4 coming up, 23.9 versus the estimate of 24.1. And you can see the fiscal year 2025 guidance overall, that was decent. Revenue coming in at the top end of the range, but once again, operating margins 29% from the 30% previously anticipated. Free cash flow, a very decent beat, and a bit more segments here for you. US and Canada up 17% for Netflix. Europe, Middle East, and Africa, 18%. LATAM, 10% to the upside, and Asia Pacific 21%. That was the highlight of the quarter for the company. But what happened? Well, here you go. Netflix shares dropped after streamer misses earnings estimates, citing a Brazilian tax dispute. Yes, a $620 million tax dispute to be specific. Streamer cited an ongoing dispute with Brazilian tax authorities for the weaker than estimated result. So blaming it on the unforeseen tax expense. The streamer said the specific expense, stemming from a 10% tax on certain payments made by Brazilian entities to operations outside the country, whatever that means, was not previously in its forecast. The company decided to charge the impact to its third quarter after it became reasonably likely that Netflix would lose a legal challenge over whether it would be assessed the tax. Here's what the CFO had to say. It's not a tax that's specific to Netflix. It's not even specific to streaming. No, it's in relation to payments made by Brazilians outside of the country. So possibly the government wanting some remittance on that. Not too sure. I'll have to look for more information from Netflix if they disclose it, but they're being very gray about it. Absent this expense, though, we would have exceeded our Q3 25 operating income and operating margin forecast, and we don't expect this matter to have a material impact on our results going forward, and I wouldn't expect it to have a meaningful impact either if you're asking me my honest opinion. Still, Netflix said it posted its best ad sales quarter ever during the period, with co-CEO Greg Peters noting that the company is on track to more than double its ad revenue this year. They gave that guidance last quarter, and they are reiterating it. The ad tier for Netflix has been one of the best performing tiers, and it's also led to some really good member growth. Netflix had its best ad sales quarter to date, but still did not provide a figure for how large the ad business is. This gives the impression that the sustained revenue growth achieved this quarter and forecasted next quarter will predominantly continue to come from subscription fees, notably the increases in their ad tier subscription fees. Netflix is also still riding the coattails of K-pop Demon Hunters, apparently the best-selling Netflix original of all time. 325 million views it's received on the platform so far. And additionally, because of the success of this franchise, Netflix announced Tuesday that K-pop Demon Hunter dolls, plush, role-play items, and themed games will be available at retail in the spring of 2026. Why do I bring this up, guys? Because this is something that Netflix hasn't done before. The company also noted that it's looking into incremental opportunities related to live experiences, publishing, beauty and lifestyle, as well as food and beverages related to the film. Now, they announced a partnership today with Hasbro and Mattel. So you remember back in the day, guys, when a lot of more people used to go to movies and whatnot, and whenever big movies would come out, you'd always see these action figures made by Hasbro and Mattel in places like Toys R Us or Walmart or other things of that nature, right? Well, now Netflix is going to be commissioning some of those products. So it's a very interesting future revenue stream for the company, something they have not done before for prior franchises. So these partnerships with Hasbro and Mattel are fairly interesting. Now, talking about Netflix as a business, where do they stand in the ever-competitive streaming wars? Here we have some data by Nielsen for September of 2025, and you can see here that of these streaming corporations, which represent 45.2% of total TV, right, monthly TV viewing by platform, Netflix stands at number 2. The king is still YouTube. Yes, so Netflix number 2, other streaming 6.3. That's pretty much an amalgamation of all smaller players. Disney 4.5, Prime Video 3.9 as well. So I assume Apple TV is bunched up into other streaming, but it just goes to show how large the actual total addressable market is. Streaming can come and take more and more from broadcasting, from cable, and from other as well. So that will be very interesting for Netflix, but they haven't really lost any ground. If anything, if you take a look at some of their earnings highlights, right, they highlight that they've actually gained share of TV time from, measuring in Q4 of 2022, 7.5% to the 8.6% that they have right now. Very solid for the business overall. Nothing bad specifically about this earnings report, but the tax event does definitely overshadow an otherwise very solid earnings season for the company. If you take a look, there's some little drawbacks here. You can see the impacts on operating margin, right? From this quarter right here, 28.2. Prior quarters were 34 and 32. The big highlights of prior quarters were the profitability of the business. That's taken a slight hit to the downside. Net income was also a little bit lower this quarter than it was in prior quarters because of that tax hit. Of course, the revenue was good at 17%, but the net profit margins only 22%. I'll remind you, in Q2, they were 28.2, and in Q1, 27.4. So this little drawback here in net profit margins and the fall off, of course, from the resulting operating margins and operating income, that's what really held back the business over the course of this quarter. However, that being said, free cash flow generation was some of the best that we've seen recently, right? Q3 2025, $2.6 billion. 2.2 in the prior quarter, and Q1 $2.6 billion again. So making a lot more money in free cash flow than they were at this same period of time last year. So that was good. And what did they do with this money? Of course, they continued to buy back shares, buying back over $2 billion worth of shares during the quarter. And they still do have a $10.1 billion share buyback authorization in the pipeline, which is about 1.9% of the company float. Other than that, guys, I mean, the details for Netflix were pretty good. There's not much to go over. In this earnings sheet right here, all they talk about is obviously the new series and stuff like that. But what you have to get from the earnings call and things of that nature is that they're going to be spending a great deal more money and attention and focus on live events and on actual physical product rollouts when they have successful franchises. These are going to be two future big revenue growth drivers as they continue to scale the advertising business as well and acquire new members. So Netflix, in my opinion, is still the de facto king of streaming, over and above Disney, over and above Amazon, over and above Apple. Even though the competition is fierce like right now, Netflix is really in the lead in terms of that respect, unless you include YouTube, of course, which is not really the same thing. I mean, it isn't. It's streaming, but it's not, content that's made for the platform. Although Netflix is looking to broaden its horizons to bring some streamers from YouTube onto the platform, which is also something that Amazon Prime Video has been doing as well. So the next question that everybody must have on their mind is, well, that's all good, right? Their quarter was fairly decent, but then there's a tax hit on Brazil. Is Netflix stock a buy now that it's down 6.31%, down into our secondary support zone down here, which is roughly the 1150, down about $1,100. You guys might remember me several times on the channel saying, if Netflix casually comes down to the 12-month EMA, I will be interested. Has this quarter changed my tune? Absolutely not. I still will be interested. As a matter of fact, in terms of the valuation right now for 2026, because now we're at the very end of 2025, most of all the year-end guidance is locked in, and for Netflix it is as well. So we can look to 2026 to determine whether or not we're trading rich or cheap in relation to there. At 1180, I know now it's 20 bucks lower, but this is not going to move that much. Forward price earnings is 36.42. Not terrible. Definitely not as bad as it was all the way up here at 1350. The forward PEG ratio through 2028 with a 20% EPS growth rate on average through that time is a 1.82 PEG. That's a little high, but it's not that bad. Not above 2 anymore. Netflix has considerably dropped since that time, and the free cash flow yield, if they do respect their guidance of $9 billion in free cash flow, is about 1.7%. So you're definitely not buying this one for the free cash flow. You'd be buying it for the quite manageable valuation down here and just the very glorious technical pullback, right? Beautiful monthly uptrend right now on this stock. Beautiful monthly pullback into our support area and possibly in line with the 12 EMA. So if we find Netflix again down here in the low 1100s, down to possibly 1,000 in this whole range, I will be looking to pick up a few more shares. I'll remind you, management's guidance for 2030 is expanding the market cap at all costs to $1 trillion. So you might be looking at 2x over the next 5 years, which is not a bad compound annual growth rate if you have any long-term share positions in mind. That's everything I had for you guys for Netflix. Hopefully you enjoyed that. Now let's move into company number 2, which is a bit of a change in gears, a bit of a slower paced company. We're going to talk about Coca-Cola right now because we want to get some insights into the consumer. We know that consumer discretionary spending has been very soft. I mean, it's a K-shaped economy in terms of consumer spending right now. K-shaped economy meaning the higher income cohort is performing very well. Arguably, they haven't changed their spending patterns at all. They're still spending strong. But the lower income consumer has just been spending less and less and less and kind of getting squeezed by the impacts of inflation over the course of the past few years. So how is Coca-Cola navigating this whole landscape? Well, they're not doing too bad. You might remember a few times over the course of the past year, Coca-Cola was reporting negative year-over-year comparable sales, and the market didn't like that. And everybody was looking for the inflection point. When is Coca-Cola going to get back to growth? That inflection point is actually here right now. Beat on EPS by 5.27% and a slight smidgen worth of a beat on revenue by about $6.93 million. Let's move into some easy numbers, or let's move into some details for Coca-Cola. Coca-Cola tops earnings and revenue estimates, but says demand for drinks is still soft, but it depends what drinks, because some of them are doing well, some of them are not doing so well. Let's move into it. And here's what the CFO had to say. After a slow start to the year, we ended with improved performance during the quarter, or rather slow start to the quarter, but also a slow start to the year. You might remember Coca-Cola started off with negative unit case volumes and also negative comparable sales this year. So they've come a long way. Coke reported third quarter net income of $3.7 billion, which is very solid, guys. Net income has never been a problem for Coca-Cola. They always seem to find a way. 29.8% net income margins, Q2 30.1%, but this is pretty much standard for Coca-Cola. They're always oscillating here between the low 30s and high 20s in terms of the most recent few quarters that they've been having. So very, very good in the last few quarters of Coca-Cola has been that Coca-Cola has been able to improve profitability across its business. Moving on further here, net sales rose 5%. And Coke's organic revenue increased 6%. That's some of the best numbers that we've seen on Coca-Cola all year. But a lot of that comes from increases in prices, right? That's the problem, because the unit case volume is not the best. Company's unit case volume rose only 1%, but volume in both Latin America and North America, two key markets, was flat for the quarter. So the reason their sales are up is because they raised prices. Coke executives have said that low-income consumers in the U.S. have been buying fewer of its products. The company is also seeing higher traffic from dollar stores, another sign that low-income consumers are feeling pinched. Coke is now trying to target them with affordable options, like mini cans of its soda, which have a lower price tag but more cost per ounce. Despite ongoing differences in spending between income groups and slower traffic across channels, North American volume was flat and improved sequentially for the second consecutive quarter, said the chief operating officer. A similar dynamic is occurring in Europe, which also saw volume decline, according to executives. The broader Europe, Middle East, and Africa division reported volume growth of 3%. Talking about the same dynamic in Europe, they mean lower income cohorts are not spending as much on the products as the middle to high income cohorts, of course. However, Coke's pricier brands like Fairlife and Smartwater have been bright spots for the company, showing that high income consumers are still willing to pay more for premium drinks. Coke saw the largest volume growth from its water, sports, coffee, and tea segment. Its bottled water and sports drinks both saw volumes increase 3%, while coffee and tea reported volume growth of 2%. The company reiterated its full-year forecast. Coke is expecting comparable earnings per share to rise 3% and organic revenue to increase 5 to 6%. Once again, probably due to the impact of the pricier brands on overall sales, but also in relation to increasing prices across all brands, even though the unit case volume, of course, as they said in North America and Latin America, two big markets, was roughly flat. Here is your Coca-Cola quarterly revenue from North America. Once again, this is the impact from the pricing power that the brand does have. So they were able to etch out some gains, but you can see it's been a fairly bumpy ride for Coca-Cola over the course of the past 2 years. But this business is tried and tested. It's a very, very strong company overall. Now, is this company a buy? I know it's a boring company. I know this one's not for everybody. A lot of people buy this one for a dividend. There's better times to buy Coca-Cola than other times, of course. The last time we were interested on the channel was back here. More recently, here was where we were highlighting during this little trough. We were commenting on some short puts down there or acquiring some shares at these lows into support. Not the worst time for Coca-Cola. The dividend was a little bit higher at that point. Very strong business, guys, right? They've been doing this stuff for decades and decades and decades. They've been through periods of tough economic times and challenging consumer demographics. EPS, solid up and to the right. Revenue, solid up and to the right for the next few years. They bring in a lot of free cash, though. They buy back some shares. They pay some nice dividends. Now, full disclaimer, guys. Coca-Cola is not a company that traditionally beats the S&P, right? But arguably, and that's including the dividend, let me just adjust for dividends, you'll see what I mean. It does not traditionally beat the S&P. Sometimes, in the context of bear markets, right, then it will outperform. You can see the S&P down here while Coca-Cola was up here. But in times of pure growth, where a lot of the tech names take over, you can find the S&P outperforming, but it's not always the same. Here you can see this blue line is the S&P. In March, the S&P crashed. Coca-Cola was battle tested and kept up the highs. So this one, depending on your time horizon, right, doesn't beat the S&P in terms of longer dated returns. At least it doesn't anymore. If you have Warren Buffett's cost basis, then you will forever outperform the S&P, of course, but no longer. But it does serve its purpose as a value and defensive name in a value and defensive portfolio, or in that segment of a portfolio. At $71 right now, it's trading right around historical price to earnings averages. You're not paying a premium. You're not really getting that much of a discount. It's just kind of average right now. But if Coca-Cola comes down into the mid 60s, you guys know the drill. That's when it gets a bit more attractive. And that's everything I had for you guys for Coca-Cola earnings. Hopefully you enjoyed those, even though they're not the sexiest earnings. I completely understand. But now let's change gears again and take a look at this. I was going to say beaten down semiconductor company, but it's not really beaten down. It just hasn't done anything in like 4 years, right? And why is that? We'll explain that briefly. Well, the reason is that, of course, it's a very cyclical business, but more cyclical than the other semiconductor companies that have been getting a tremendous lift from the data center build out. This one, unfortunately, has not. No, because it's more of a consumer-facing business, and they also do a lot of stuff in China as well. If you guys don't know Texas Instruments that well, it's a very large player in the semiconductor world. I mean, we're talking here about a company not many people talk about. It's a $165 billion company, and they have so many products, guys. Over 80,000 different parts in this company. Everything from amplifiers, clocks and timings, data converters, calculators, sensors, and even telemetry systems for missile applications. I know you wouldn't think so, right? But TXN does have something to do with some of the defense contractors as well, but so many different parts. The problem is that this company sells analog semiconductors, right? And a big portion of that business is focused on personal electronics, but also the Internet of Things and embedded applications for commercial and industrial, but also they do a lot of things for the auto business. Those three things have been very weak for the semiconductor landscape over the course of the past 2-3 years. It's been a very cyclical period of time for these businesses. They had a tremendous amount of demand in 21, 22, tremendous amount of pricing power, and then with supply chains and people running out of money and having bought all the goods, all the iPhones, all the TVs, all the electronics, all the computers, all the cars, all of the everything, and even industrial applications, right? Businesses, by large and by far, spend a ton of money on CapEx, renewing their systems, renewing their electrical systems, their electronic components, all that good stuff. And then we had a bit of a lull period, not only on Texas Instruments, but every single company that's associated with this segment of semiconductors. Qualcomm, same thing, very lumpy from 22 into 2024 and even 2025. MCHP, same concept. EPS, big up and then big down. You can see that in the revenue streams as well. Another company that we talk about sometimes on the channel, On Semi, right? ON Semiconductor. That being said, same thing. EPS, big boom, and then EPS and revenue, big crush. And for the last year and a half, we have been trying to determine when is that cyclicality going to end? It also has to do with consumer spending patterns too. So although these are semiconductor companies, they are in tune with consumer spending habits, right? So we know the consumer's been somewhat soft. It's a K-shaped economy so far, which is why you're not seeing that much in terms of electronic sales, in terms of auto sales. We know those businesses haven't been doing too well. And we also know that companies, other than the ones doing data centers, aren't spending that much for a big CapEx refresh cycle, as they were back in 2022 when rates were zero, right? So that being said, that's why this company has been soft. Have we finally come to a point in time where these companies are worth an investment and as they're in inflection point with better demand in the future? We've been trying to ascertain that for like the past 4 quarters. And there's been some ups, there's been some downs, and more ups and more downs. How are we standing right now? We'll take a look at their earnings, guys. Unfortunately, they missed on EPS by 0.58%. They beat on revenue by 2%, but it wasn't good enough, man. The guidance for Q4 was just not there. Now, earlier this year, they said that the growth would come back in the second half of the year, and they were unable to fulfill that promise, sadly. But a lot of that also has to do with some of the tariffs and their China business. So let's explore some of these numbers, shall we? Now, in terms of their easy numbers, Revenue, as you can see, year over year, that was decent, 14% year over year. EPS, lagging, only 1% beat on EPS year over year. So tough comparables, and the growth is not back. The profit margins are sustaining, but still not growing that much. Free cash flow as a percentage of revenue was up 51% year over year, which is good. And operating cash flow was also decent this year. But this company and many others in its niche of the market have spent in the last few years a tremendous amount on CapEx, and they're also sitting on some stale inventory too. So that kind of impacts the business as well. If you take a look at quarterly revenue by segment right here, this little blue squiggly line here with the circles is net income margins. You can see they do not have the same margins as they did back here in 2021 and 2022. They don't have the same pricing power, right? Everybody's competing for each other's business. So net income margins have been driven down, still to a healthy level of just under 30%, but definitely not the mid 40s as when this segment goes through a big expansionary phase, which we hope is coming at this stage, 2026 and 2027. But their analog systems have had a upswing since the lows of 2024, and embedded processing as well, which is your black segment, has had a nice upswing here since the depths of 2024. So not all that bad. It's a slow inflection point, right? And 2026 should be a better year for the company. Taking a look at more earnings headlines here, chipmaker Texas Instruments forecasts quarterly results below the estimates on tariff pressures. Macroeconomic uncertainty stemming from U.S. tariffs and America's trade war with China threatens a demand recovery for the company's analog chips. See, everybody's talking about the demand recovery, man, and it's not so obvious, right, to time that, because you're talking about a whole cycle. Successive U.S. administrations have worked to curtail China's access to U.S. chip technology, resulting in Beijing taking measures to boost domestic analog semiconductor production on their own, casting a shadow over TI's ability to address a key market. With tariff discussions on the horizon, trade tensions between the US and China, which usually make up nearly 20% of TI's annual sales, have lingered. TI expects revenue between 4.22 and 4.58 for the fourth quarter, which is not what the market wanted to hear. The expectation was 4.1, near the top end. Now, we've missed that, unfortunately, by close to 5%. That's a lot. It forecasts per share profit between $1.13 and $1.39. The midpoint, $1.26. Unfortunately, that is 10% lower than analysts had penciled in at 1.41 per share. Data points in the automotive and industrial end markets remain very mixed, especially in light of tariffs and trade disputes. Notice automotive, industrial, but they don't talk about personal electronics here, but that too has been somewhat on the rocks. While investors were expecting some moderate downside in the fourth quarter outlook, the guidance was perhaps a tad weaker than expected. The company has been investing heavily to expand production capacity as President Donald Trump pushes to onshore chip supply chains. So, I mean, it's not all that terrible for the business, but of course, this guidance was very underwhelming. It just pushes back the timeline of the infamous demand recovery, right? Possibly due to tariffs. Our cash flow from operations of $6.9 billion for the trailing 12 months underscored the strength of the business model. This is true. What did they do with that operations cash flow? Well, free cash flow, right? Other than CapEx, because they spent a bunch of money on CapEx here. You can see they spent, well, not only on CapEx, but $3.9 billion on R&D and SG&A, $4.8 billion on CapEx, and returned $6.6 billion to owners over the past trailing 12 months, which is good. Free cash flow for the period was $2.4 billion. Not terrible, not terrible. They're talking about the last trailing 12 months, but I'll remind you, free cash flow is not what it was because the profits have went down as well over the past 2 years, right? This company, look at this free cash flow, 2020, 2021, 2022. Look at the amount of free cash flow this company was generating. Now, what happened? Well, 23, 24, and 25, free cash flow went down the tubes, and it's still down the tubes, very thin free cash flow, but also this red bar right here, the debt, started creeping up as the company spent more money on CapEx, so it has the production capacity to get through the next boom cycle, which of course we are going to reference is this phase in time right here, the ever elusive boom cycle of back to big growth in EPS and back to big growth of revenue as well, which should be coming tentatively 26, 27, and 28. So this whole segment of the market has been one that I've been waiting for. And to be honest with you, it's one that I haven't really been keen on positioning until we get the actual green light until they give us one quarter where it's clear that the recovery is underway. Now, an argument to be made is, well, maybe we should be bidding this stuff before that actually happens. And I agree, but you want to be closer to the end of a trough than from the beginning, right? And I do believe now that we are closer to the end of the trough in terms of cyclical demand than we are to the beginning. The company's been doing literally nothing over the course of the past 4 years because, I mean, look, these were the highs of 2021, right? Is EPS back to the highs of 2021? No, not even close, right? It's about half that right now. Is revenue back to the highs of 21 and 22? No, not yet, right? Only 2026 will they be able to achieve that. So Texas Instruments for us right now is an interesting case study in cyclicality for semiconductors. Now, at 165, they're coming very close to an area that I might be interested to play, talking about the 161 to 145 big 3-4 year area of support, and they're doing so with some decent valuations. At about 165 right now, your forward PE is 25. Not terrible. They're growing revenue and EPS at nice clips through 2028 on average. They have a 1.55 peg right now. Decent. Worth a bid if this is your style of company, in my humble opinion. Free cash flow yield is not what it was, but we showed that on the graph. It will probably in the future be returning to 3% plus perhaps, but that's going to take quite some time. So Texas Instruments, my verdict, is it a bid? Is it not a bid? I do think it's a bid, but it's not going to be a massive, quick data center recovery bid, right? However, I do believe that in the next few years, buys on Texas Instruments down here will be rewarded with a fairly decent compound annual growth rate. Once again, this is not the sexiest company in the whole semiconductor landscape, but it's part of a whole host of semiconductor companies that haven't gotten much love. Qualcomm's in there, onsemi is in there as well. Companies like MCHP are in there. Marvell is in there a little bit. Got a lot of questions on this one in the past few weeks. Now it's coming down a little bit. So it's that whole segment. So whichever company you guys have as a favorite in that segment, I do believe we're nearing the end of cyclicality of the entire segment, and Texas Instruments might just be one that you would want to explore a bit further. And that wraps up all our earnings for the day, guys. Hopefully you enjoyed. Now, let's jump into some charts, shall we? Okay, so talking about the S&P, we are still in the context of a very nice new daily uptrend with the higher lows being set at 657. Any move lower looking for a new higher low, possibly for further trend continuation and possibly to attack the new all-time highs. However, if some of these bearish narratives rear their ugly heads again, that might be challenged. So keep your head on the swivel. Now is a good time to be playing the volatility in the market, and also a very good time to be spotting the rotation. Follow the money, guys. And that's how you will also have a good chance of making a lot of money rather than chasing names, printing the all-time highs. When that's happening and you know they're going to pull back, you got to look to where the money's going, right? Skate to where the puck is going, not to where it is right now. Moving on to the QQQs, I'll cover these charts quickly because nothing has changed, and I want to get into our rotation talk later on in the video when we go through the biggest gainers and losers list, right? Moving on here, QQQs, same concept, daily uptrend, higher lows are set at about 596, looking pretty good. Any move lower, looking for a new higher low, possibly for further trend continuation. If you unwind the entire move because of the bearish catalyst, you guys know the drill right here. That would be a weekly downtrend as your weekly higher lows are set at 589. Weekly downtrend into a bit of monthly consolidation. And after 6-7 months of rally, the markets at any point in time could definitely use that. It would be a healthy pullback, and I will be there to buy the dips. But the rotation right now is the name of the game. Speaking about rotation, we'll take a look at financials. Financials still trapped, unfortunately, in a big old daily downtrend, reacting from the resistance range, 53.31 down to 52.85. It was a nice push by the bulls, talking about a 618 retracement, which does give them enough space to kind of do something like this, right? The good old 1-2 step daily uptrend recovery. We will see, though, if they come right back down here, you got a huge area of support, talking about this whole 52 down to 50 buck area for consolidation on financials, which at the end of the day is just a very healthy monthly higher low attempt for the print. In terms of the banks, I still do like several of the banks. I like JP Morgan on its consolidation. If you move into further consolidation, monthly consolidation, it could be really interesting, right? So just staggering some buys midway through, not the worst opportunity as JP Morgan retests the 285 range down there. Names like Goldman Sachs have roughly the exact same setup, or we can play the names that are already at very attractive levels, such as Visa. 340 down to 330 is an area that I definitely want to play, and all of the other names like SPGI, right? This whole 485 down to 460, phenomenal company, still stuck at 2021 all-time highs on improved fundamentals and a very good outlook for the next 2 years in terms of the amount of debt that they will have to re-rate, which is a big portion of their business, looking for the expansion to the highs. So there are deals all over the place in financials, depending where you are looking. Moving on to healthcare right now. Healthcare up 0.23%, and I guess another 0.53 in the after hours. Healthcare is going for the good old daily swing up into resistance again. Talking about 148 down to 145 is the resistance range. Prior resistance should be fairly obvious what they're trying to do. Looking to persist and continue into another weekly leg higher. For any buys bought down here, I'll remind you this is take profit area number 1, and the all-time highs is take profit number 2. At least those are my price targets for possible continuation. Healthcare still remains one of the more undervalued and underloved segments of the market, but we're starting to see some players crush it. ISRG, man, I've been buying. I don't talk about all the buys, but I've been accumulating some ISRG, man. I started buying ISRG this year during the March sell-off in my long-term portfolio. I've staggered my buys every month here and there. Been very happy to accumulate some in the lower 400s and now pushing 17%. I don't talk about this company that much, but it is one of my favorite companies in the entire healthcare landscape for these 3 key reasons. That being said, it's not a cheap company. It is expensive, but that's because they have a huge market share and a very strong moat as well. Maybe we'll cover their earnings later on throughout the week. Moving on to SMH right now. SMH down about 0.55% today, but no change on the charts. We still have a big old daily higher low all the way down there, which the bulls are looking to protect. Any move lower looking for a new higher low, possibly for further trend continuation. We will see, because some aspects of semis have been moving well. Other aspects of semis like NVIDIA is just like a stable coin at this point, right? They're doing absolutely nothing. Broadcom as well, doing absolutely nothing since their earnings. So 2 of the very large players have been doing a whole lot of nothing, which is why this chart is kind of just stuck up here, right? You're going to need some performance from the Texas Instruments and the Qualcomms of the world, especially if your bigger players are just kind of nowhere to be found. That being said, the chart still looks decent, but if they hit you with a good old unwind, which is possible, right? You're just going to be looking for a new weekly higher low, possibly down here to the 12 EMA, which would be the first line of defense. It's still overbought conditions, and semiconductors could do with a nice pullback, and the chart would not look so awkward. And lastly, the Russell. The Russell down about 0.5%. Very awkward price action right now. Big downswings, big upswings, of course, but still, in the context of a daily uptrend, higher lows are here. 241.56. If you unwind this, you lose the daily, and you might just be going into the infamous weekly consolidation, which would be a nice opportunity if we come down here, 231, 225, to possibly start some swing trades. That is the 2021 highs. Resistance that plagued this ETF for a couple of times throughout 2024 into early 2025. If we make our way back there again in some attempt to set some monthly higher lows for a nice cup and handle pattern, you probably will find me bidding right there, but it's going to need some overall market pullback to get there. If not, if you want to stagger the buys, it would be some here, because you never know. They could just run with it, right? So stagger the buys, some here if you want to build a position, but the positions that you do build, you need to have a longer term thesis, guys. The growth expansion of the small cap names will not happen overnight. It's going to be a progressive thing as rates get cut over the next 12 to 18 months type of cycle, right? That being said, moving on to the VIX. The VIX doing absolutely nothing today, down another 2%. So well off the highs that we saw earlier this week, where people were really fearful. I mean, the markets are still arguably pretty fearful. We're still trapped in the fear category right now, even with markets at all-time highs. That's just because the breadth wasn't very good, but the breadth has been improving over the course of the past day or so, right? That being said, still a decent opportunity to be looking for selling options, right? Whether it's covered calls on some names that ran a lot for you that are just trades that you want to possibly wind down, and or selling put options, maybe with some really good distance, maybe on some names that are going down 10% a day. If you felt that you've been left out of these, and they're coming down into big levels, and you want to lock in a certain price and some good volatility, maybe short put orders could possibly be your best friend. I don't know. I'm just speculating out there, but that's it for the VIX. Moving on to the 10-year yields right now. 10-year decently down, right? We're not going to cover these every day, but I figured I should just add a little bit more. Nice weekly downtrend. You're going to be looking to crack 33.885. And on the 20-year yield, nice daily weekly downtrend as well, looking to kind of break down here below 4.4, which is the bottom of the March and February areas, and also last November. So we're going to look to go back down to where the Fed actually started cutting rates the first time. And then yields just went completely opposite of the actually interest rate cuts. But not too bad. Now we have compression on the 10 and 20 spread, which is very decent, and a reason why your bonds are seeing a little bit more of an uptick right now. So bonds still decent, but the time to accumulate, as we said on the channel for many, many months, was down here. Are you late to the bond trade? Yes, you are late to the bond trade because we're not expecting bonds to do this, right? I mean, we were taking trades from here with first take profits in order and second take profits at $100. At least that's my setup, because obviously we know that rates don't move, you know, like Palantir or anything like that. We will have subsequent rate cuts into 2026. The TLT trade is well underway. So take your profits accordingly, depending on your trading strategy. Moving on to gold right now. Gold, huge engulfing move to the downside, 5.3%. I think, now I'll go out on a limb here and say, I think that is the end of this most recent leg of gold's story, right? Whenever you get these big engulfing moves at the top end with volume climaxes, that tends to mark a local top. Notice how I say local top, because the longer term bulls are still fully in control. Now, we haven't lost the 12 EMA, but this is definitely one of the times that it's been the most challenged since breaking out here in the middle of the month of August. If you get further declines, your daily higher lows are down here, 39.42. You do not want to see the bears. If you're a gold bull right now, you don't want to see the bears take back much more than this. This is your 618. The bulls still have a chance to save this. If you move further down the Fibonacci spectrum to a 80% retracement, 90% retracement or full, then the odds of doing this, guys, I mean, it takes a lot of money to do that, right? If they would have done that, they would have done that from up here. Not all the way down here, accumulate more, and then shoot up V-shape as if this entire move was not even there, right? I understand it's central banks, I understand it's big money moves, but like I was saying yesterday, you do not know when they're going to taper back their purchases and hedge their positions with futures, right? Because that's what central banks do. So keep that in mind. That being said, big sweeping move down on gold. I do not know how low we're going to go. You're just going to have to wait for the price action to tell you, but something has clearly changed. Big loss of the 4-hour time frame. That has not happened in like over a month at this point in time, sacrificing the 4-hour 50 EMA right there, right? And also on the weekly, not a very nice candle. The monthly candle only has 9 days. And there's weekends in there, right? 9 days. If you give back any more of this and you end up with a massive doji, that is going to be synonymous probably with the top of the move in gold. Maybe, who knows? Maybe we should accumulate the levels and stay range bound like right here. We don't have to go all the way down there, right? Maybe just some sideways action, but that definitely has all the ingredients. It looks like a blow off top. It smells like a blow off top. So maybe indeed it just was a blow off top. Hopefully you guys are able to lock in some profits, because the FOMO up here in the last few days, I could feel it in my comment section. I could feel it in the Discord. I could feel it when I was going online. The FOMO was real up here, very real. And when that happens, when everybody starts talking about gold, even that people that aren't even in the markets that frequently, you got to take the hint, right? Which is kind of the same thing that happened to a lot of these names over the past few days as well. When everybody starts talking about them as if it's such easy money, maybe it's not such easy money after all, right? Moving on further to our Bitcoin analysis. Bitcoin actually down. What a big day on Bitcoin. Look at this massive upswing this morning. Right? Huge upswing. Bitcoin at a certain point today was up almost 3%, 5 to the upside, and then now 4.5 to the downside, ending actually red. This candle closed in about an hour. Big volatility in crypto right now, but that's good for us if we're looking to play said volatility with some short put options, right? Big daily downtrend. The bulls, nice move, nice retracement size, but they're not out of the woods just yet. That's an 80% retracement. Not out of the woods just yet. You have to give me the trend change. So we'll see if they can do it. If not, the bears have a second attempt to possibly flush through this resistance area. 107 down to 99, which is a fantastic area. Prior resistance, and current support. And it's just a nice location for some monthly extended consolidation into the infamous 12 EMA, which the bulls have been holding this whole time. Am I a fan of accumulating more Bitcoin every time they peak down into this area? Yes, and I am. Am I a fan of selling some put options on Bitcoin ETFs and leveraged products? Yes, indeed I am, and I continuously will if they give us these nice volatility moves. Moving on to Ethereum, same concept, right? The daily bulls not looking the strongest. They're trying their best to protect this level right here, 4,000 down to 3,700, but we do have a big sweeping weekly downtrend underway, which is synonymous with a bit of a monthly retracement. That being said, nice engulfing move here, looking for the good old cup and handle. If they do not hold the market there, you guys know we're dropping to the next support level, starting at about 33. And I know what people must say, 48 to 33, I mean, yeah, it's Ethereum, guys. You got to get used to it, right? This one moves very, very fast, right? So that being said, I am playing some of my favorite Ethereum products, well under the market, selling some put options. And in terms of accumulating long ETH, yes, here, but save some for possible deeper retracement down there. That's how I'm playing Ethereum. It's into our level. It's nice, but you know, you can't get it twisted, right? You got to always hope for the best, assume the worst. So save some buying power for the good old 33. It would just be looking for a nice monthly higher low towards the 12, possibly for more expansion come 2026 or something like that, or Q4. Moving now on to our big tech names, now that we're through all that. So getting into Apple first, Apple continuously printing the highs, and to be specific, new all-time highs. Very strong for the business, but very tough to position up here. I've been very clear on that. Fundamentals, a little bit overbought right now for some longer-term positions, right? We did it at 250. 3.26 peg is what you're paying, guys, for 5% revenue growth and 10.5% EPS growth. Solid business, but there was a time to buy Apple. The time was down here. The second time to buy was there. And now you just kind of got to let the positions run at the current time. That being said, daily higher lows are here. 245, any move lower, looking to possibly set a new daily higher low, maybe into these guys, and possibly go for the uptrend continuation. The clearest time frame for me remains the weekly time frame. Apple weekly bulls remain in full control of this chart right now. Very nice expansion, very nice iPhone 17 sales. iPhone Air sold out in China. iPhone 17 sales everywhere on backlog, back order, 3-4 weeks. Very strong, 14% increase in comparable sales, 17 versus 16 year over year. Very good, but it's ran a ton. And this indeed was the final take profit area for our call holders that had some take profits here and the second batch at the all-time high. Congratulations to everybody who got in with us for those call options down there. Those are really solid. Moving on to AMD right now. AMD down about 1.05% today, but not losing any major structure. That will be down here, 228.26. If you lose that, you lose the daily uptrend. Rising wedge? Possibly, right? You got to pay attention to that, because if they break bearish, they usually tend to break hard. Bulls are still in control, but pay attention. That is your line in the sand. If you do drop a little bit, well, you got a lot of space, right? Anything above 150 is just looking for a weekly higher low for possible further trend continuation. Am I a buyer of AMD up here? Well, you got to ask me what my time horizon is, right? If it's 2027, 2028, yes. If it's like the next 2 weeks, well, I mean, guys, we're really extending on the RSI, right? 80. So that being said, the last time I was buying aggressively, and I was very vocal about this on the channel, was down here because we were looking at the good old monthly cup and handle formation. It was very beautiful, and now the prophecy has been fulfilled. As of right now, though, around 240, you're looking at over a 2 peg. Over a 2 peg. So now AMD is no longer cheap. I wouldn't say it's egregiously expensive, but you can't also say it's cheap anymore. That being said, the long-term thesis for the company is clear. Any shares bought here, 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 here should be pretty good into 2026, 2027, but starting a brand new position here, like I said, if you have a timeline, 2027, 2028, and you're going for the big $300, $350, $400 per share, which is plausible, it's good. Are you going to get as good as a compound annual growth rate? Are you going to get as good of a compound annual growth rate of return as us from down here? No. So you got to keep that in mind, right? Moving on to Amazon right now. Amazon up 2.56, down 1.07 in the after hours. Amazon's just all over the place, right? That being said, not too bad of a day. Nice push by them. We had a nice daily downswing here by the bears, pushed right into our support area, 213 down to 205. This was a great area to be selling some put options, as we were saying for the past couple of weeks. And now we're right back into resistance, right? So the price action right now, unclear. You need the bulls to do this. Will they have time to do that before their earnings next week? I don't know. Possibly not, but crazier things have happened, of course, right? So reacting nicely from support. I'm not going to comment too much on Amazon's short-term price action just because we have a huge earnings catalyst in about 5-6 trading days. So the trading's probably going to be muted, and then you're going to have a 6-7 point or 6-7% move to the upside or to the downside, which is gonna break or reset any price action. Currently, is Amazon still a buy at these levels? I honestly do think so. At 220, you're looking at a very decent valuation here of a 1.74 peg. On to Google, good old Google, who had all the news headlines in the world today. Down, up, sideways, backwards, everything under the sun. That being said, who controls the time frames? Daily downtrend, right? Now into nice engulfing move and looking for some higher lows for further trend continuation. They got it in the after hours. They got the new all-time high. They're up to 260 in the after hours. Are they going to get it tomorrow? I guess we will have to wait and see. Google also has earnings next Wednesday. So I'm not expecting a crazy blow off top before Wednesday. Maybe. I'm not expecting it though. I'm also not expecting a crazy breakdown before Wednesday. The expected move should be about 5 to 7% either way. So we'll see what happens. Google bulls still control the price action on this stock. Your weekly higher lows are down here, 237. I don't expect that to be broken much before earnings, but we'll see. Around 250 is Google still a buy? Not too bad, honestly. 26 forward price to earnings and a 1.73 peg. It's a nibble for me. I mean, you guys must remember me. I was the Google guy on YouTube. Everybody hated this stock, except for a few people, of course. Everybody hated it. I was accumulating so much Google back here and lastly up here, but no longer. But if I had to, yes, it would indeed be a little bit of a nibble up here just because the valuation and further growth forward growth prospects are still decent. Talking about Meta. Meta, not too bad, but it also has earnings next Wednesday. So we're cutting it a little bit close here. What they're trying to do, they're trying to go for the daily uptrend, right? Break above 734. They tried it today. Not quite going to give it to the bulls just yet, but we did create a nice space off 700, which is your support low, 706 down to 680. This was a good area. I was vocal at the time a few weeks ago when we were buying Meta. I mean, up until this week, right? This is a decent area to DCA on Meta for some long-term shares. Yes, it's a weekly downtrend, but also it's very nice monthly smooth consolidation in the context of a very nice monthly uptrend. So these pullbacks, right? These 10, 15% pullbacks from the highs, I enjoy playing those on Meta, and I did add a few more shares to my long-term position. In terms of your forward expectations here, well, the PEG ratio is a 2.12, forward price to earnings 27.5. It's not the cheapest company, but it's not incredibly expensive either, which is why it did get a bit of my capital down here at the lower 700s. Moving on to Microsoft right now. Microsoft also has earnings next Wednesday, so we can't really say too much. I'm not expecting Microsoft to do this before earnings, just as I'm not expecting Microsoft to really break down like this before earnings. So you might just be trapped in this same wide range of price action, 520 down to these guys down here about 500. So pay attention to that. I mean, price action, it is what it is right now. The bulls are trying to go for something, right? Getting rejected. They're trying to go for something. We'll see if it actually happens. They have this whole nice bull flag accumulation zone right there with a bullish leaning bias. Why do we lean bullish? Because they control the monthly time frames, right? So maybe we'll see, but Microsoft has done nothing since that last earnings blow off top. So we'll see. Are they able to support this valuation and pump out better and better numbers? A lot of the emphasis will be on Microsoft Azure, and Azure had excessively good growth last quarter. I don't know if they can print another 39% quarter. Suffice to say, if they don't, maybe it triggers a bit of downside, and if that does happen, you will find me buying Microsoft here, 470. I've been waiting for this back test of the 12 EMA for some time now. If they give it to me, I will play, just like Netflix, right? We've been waiting for this back test on Netflix down to the 12 EMA. I don't know for how long now, but I was talking about it all the way back here. I was saying maybe not the smartest time to position on Netflix. You might want to wait for some consolidation. Some people were saying it's not going to happen. Netflix is running away with it. Everybody's worried about the tariffs, and tariffs don't affect Netflix. Well, here we are, months and months later, still consolidating at this point in time. 1153 down to 110 is going to be a nice area, in my opinion, to start the bidding for some possible shares. No swing trade longs for me. The price action is still very choppy, right down into this 12 EMA, which would be under 1100. This whole area, guys, I'm going shopping on Netflix. I'm going to buy some more shares as we just covered their earnings, and their earnings were very good. So these pullbacks can definitely be, decent times to possibly add if you have a long enough time horizon. Of course, moving on to NVIDIA. NVIDIA is a stable coin. It just doesn't move. I mean, there's been some downs, there's been some ups. We are at the same price as we were at the end of the month of July, and that is on very solid earnings that we had last quarter, but for some which reason, they're just not bidding this one, right? So line in the sand remains 177.29, break that to the downside, and you have a official daily downtrend, and you have a bit more of a weekly retracement underway. The weekly higher lows are down there, though, 164. I'm still enjoying selling some put options on NVIDIA in the lower 170s, and maybe even some further swing trades from 170, because you'd just be looking for a good old monthly casual, right, consolidation phase in the markets, maybe before earnings. Wait for the monthly 12 EMA to catch up. It's going to move a little bit here when the candle closes in the next 9 trading days. In around 175, is it a decent deal? It is actually a decent deal. Only trading at about a 1.71 PEG ratio, and forward 2026 is about a 27 forward price to earnings. So it's not that bad. I'm a big fan of playing these consolidation ranges on NVIDIA. Moving on to Tesla right now. Well, we can't really say anything about Tesla. They have earnings tomorrow, and they're probably going to move. Well, the expected move is about 7-8%. So, I mean, 7% to the downside, and you're going right back down here into support, 405 down about 383. And that might be a nice opportunity to pick some weekly lows. If you get some nice consolidation, big weekly upswing, right? Maybe some nice consolidation into a nice support range. Maybe we can find some swing trades there. If it goes 8% to the upside, well, obviously you're off to the races, brand new all-time high, and people are going to be chasing, right? But tomorrow is going to be the age-old battle of the short-term negatives. We will see, are they getting more positive? They're still not going to be that great, but are they getting better than last quarter, which was arguably a very bad quarter for the car business? Will these short-term negatives continuously be offset by people's optimism for the long-term positives? That's the age-old discussion with Tesla. Always has been and probably always will be. So I'll be reporting the numbers for you guys tomorrow after the close. No positions on earnings for me. Moving on to Palantir right now. Palantir as well, suffering the NVIDIA treatment, doing a whole lot of nothing for the past month. Range lows, range highs. Whichever way this one breaks, that's going to be your direction, of course. Break to the upside, give me a little back test. Maybe good for a swing trade. Break this to the downside, though, and you might find me looking for some short put opportunities with a high VIX down here around 150, which is your big weekly level of support and possibly a nice area for a bit of a monthly pullback into the 12 EMA, something that we waited for Microsoft, something that we waited for Netflix. Maybe, just maybe, we get the same opportunity on Palantir. The monthly timeframes definitely desperately need it. Will we get it, though, is a different story. No positions on Palantir up here for me, but the chart is not looking bad. It's just very choppy. Moving on to SOFI. SOFI had a ridiculous day yesterday, 8%. And what did they do today? A whole lot of zero follow through. SOFI's been doing that a lot, right? It's really struggling to break into that $30 territory right now, but the price action is not looking too bad. Line in the sand levels remain at 25.7. If you unwind this and flush, daily downtrend again, and just an extension of weekly consolidation. At that point, it would be in effect a weekly downtrend if you come down and flush these lows around 25. Weekly downtrend would mean good old monthly consolidation. And I will be a big fan of buying SOFI here, as the valuation there is not that bad, only a 1.61 forward peg and a 9 forward price to sales. And also, it's a nice technical area of support prior 2021 highs. So I've been having a lot of fun on SOFI red days, just selling some puts down here. It's been very profitable. So if it does happen again, you will find me taking that trade again. I'm not selling any shares of SOFI, though. If it does break out, I'll be a very happy camper. I'm just saying if I'm looking to add, it'd probably be down there. Moving on to Uber right now. Uber, still very choppy, right? Daily downtrend, lower highs, maybe looking to crack this support range, which ends at about $90. The weekly timeframes shed a little bit more light. This is a big retracement by the bears, right? Big leg up, small retracement. Another leg up, bigger retracement, and now almost a full retracement. When you see that happening, it means the bulls are running out of juice. If it does happen a little bit more, you're going probably for a monthly retracement on the stock, which could make us revisit the 80s. But who knows? They do have earnings coming up in 2 weeks' time. Maybe we do that retracement, come into earnings, and they smash it and go for the leg of upside. I don't know, just speculation at this point. In around $90 is it a decent buy? Yes, valuation is very decent, and the growth of the business is very decent as well. In the low 80s would be perfect lineup of technicals, huge resistance, and fundamentals. So that is the area that I'm favoring on Uber. If you do flush through this floor right here, you will find me finally selling some short puts down there and maybe even looking for a bit of swing trades and adding some shares to my long-term portfolio, but I'm being patient with it. And lastly, but not least, Taiwan Semiconductor. TSM, I mean, not the best since earnings, but we covered the earnings on the channel. Their earnings were insane. Absolutely insane by all metrics, especially profitability. The problem? The stock has ran a ton, right? Look at the monthly time frame. It's super extended from the 12 EMA and monthly overbought conditions. Look at the weekly time frame. It's super extended. So all good things come to an end eventually, right? I know a lot of people were expecting TSM to just blast off with this earnings, but do not forget, it already blasted off from these lows. Is 38% since September not good enough? That's insane, right? So if we start losing this 12 EMA and start losing some price action structure here, moving towards the lows, You may just get the daily downtrend follow through. You may just get the weekly retracement, which would be a very healthy pullback. Pullback from weekly overbought conditions, pullback from, arguably a very extended chart right now, maybe move towards the 12 EMA, which could provide a bit of support. That is my thought. Those are my thoughts on TSM. Is it still a buy up here? No, I said this after earnings, right? If you have a very long-term time horizon, 5+ years, TSM at these multiples is a buy. However, you have to understand that even though the fundamentals are cheap, the technicals are extended. You want to find an opportunity whereby the technicals look good and the fundamentals also look good. Consolidation phases like this, to be specific, right? So if you get another one of those, then the technicals will make a bit more sense and the fundamentals will make even better sense. That is how you line up the two in order to get the best possible entries. And with that, that wraps up all of our market rundown. Hopefully you guys enjoyed that. Now, let's dive in to the good old rotation discussion. You can see some of these names got hit really, really hard in normal market hours. Some of them got hit even more in the after hours. Look at this. ASTS down another 7 in the after hours. Iris Energy down another 5 in the after hours. APLD was down over 10. Now they were down over 10. They closed at 936. They're down another 2.67. So much damage in people's favorite names of the months of September and October. And we're going to get into it right now, right? So we were talking about this, guys. I kept telling people, please, 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 do not chase these names. They always give ridiculous, hardcore pullbacks. Just wait for them if you're interested, right? SMR, does this company have any revenues? No. Does it have a whole lot of hype? Yes. Will their products be used in the future? Yes. The very distant future, not the very close future, right? So this stock entirely runs on hype and headlines. And that is a good recipe to get trapped in bullish headlines and bullish hype on a company that has no fundamentals. That being said, with big drops, with very big speed, 33% in 4 days from the top, that's huge. That's huge, guys. That's more than some stocks drop in 2 years. This did it in 4 days, right? With good volatility comes great opportunity sometimes. We're able to find the low 30 strikes. We haven't had an opportunity to buy SMR in the low 30s, arguably since the end of the month of June. It's still the same business down here as it was up here, but you're getting a much better price. That would almost be a half off discount. So as a result, you will see me playing these a bit more aggressively now because I've been patient and I've been waiting for these pullbacks. Now that they're happening with high VIX and high volatility, I'm starting to play them. You can see here, I have the October 31st $30 puts, and we got those for about 28 cents, which is almost 1%. Crazy distance on my strikes. For me to get assigned those by next Friday, the stock would have to drop an additional 22% on top of already 33%. So I'm playing the volatility. If it doesn't fill me down there, I don't care. I don't really want the shares. But if you give them to me down here, at least I'll have been patient enough to get them at a very strong level of support and a fraction of what they were all the way up here. That's how I'm playing them. Same thing with Oklo, although this one is way too high. If you're asking me my opinion, I won't even be interested on Oklo until they come down to 80, or if I can get some short puts in 80, but this is just way, way, way too much. Same situation as SMR. There's just nothing to show on the balance sheet, right? This company won't have tech up and running for the next 3 years. So what are we doing here? We're buying future revenues for 2028. What's the stock going to do from now to 2028? Just blast off to like $1,000 per share and $100 billion market cap? Maybe, but not in a straight line. So until that time happens, right? Just be very patient, wait for the pullbacks. MP Materials, same concept. Everybody got really excited after the China news, got trapped at the top. And now look, we're down like what? 25% in 5 days. Very decent pullback coming into support right down here, 62 to 60, which is where the valuation makes a bit more sense. I'm not saying it does make sense, but it makes a bit more sense than it does, of course, at $100. Same thing for the names like USAR. A lot of people were asking me up here, can I buy it? And I was saying, guys, like, what are we doing here, right? Why are we chasing this stuff? We had it on the channel back here. A lot of people took profits on their call options into this move. Now you're getting the nice pullback, possibly the daily downtrend back to reality. Under 20 might be decent, right, for future bids. And you don't have to, you don't say that they're not there, guys. I mean, they're there, right? They're there. Just, you got to play short puts on these names if you want them. If you want them is a very big word, right? Look, for next week, I could find some, I could find 0.5% or even 1% at the $20 strike. The stock was literally just $44 like 3 hours ago. You know what I mean? Really nice pullbacks, really nice volatility. So pay attention. That's how I'm playing them. APLD, same concept. You finally see me with a bit of APLD in my portfolio right now. I didn't play it. Now we're playing it on the downside. 25 short puts, we got them for 30 cents. That's 1% by next Friday. Come down and fill me, no problem at all. I'll take them with the volatility and run the wheel off of them, but at least I'll know I'm playing a very large pullback. I'm not perpetually chasing call options up here, paying excessive amounts of volatility premiums. No, I'm waiting for the volatility to crush the price into me. If I end up with any shares, I can embark on a DCA process as this consolidation phase for the stock goes on further, right? So we'll see how APLD drops. If they drop, how much they'll drop. If you ask me how much they'll drop, I don't know, guys, and neither do you. All you have is prior support levels to base some entry positions off of for nice retraces. And when everybody down here is going to be complaining that the stocks are finished, no, we're going to be buying them for possibly the second more logical move for that part of the market for the AI boom. This is the illogical move. This is just hype, momentum, and retail FOMO. You get a lot of people out of that trade, and then you can actually start diving into the fundamentals and actually waiting for the deals and the pipeline for revenue to actually build up in the future. Same concept for Iris Energy. Iris Energy, phenomenal company. We covered it after earnings, and I did say it was a very decent, attractive buy down here for forward growth. Now, 2x, almost 3x higher in what? A month and a half? Now we're finally pulling back, right? So how do we want to play these pullbacks? With some short puts, but stagger your orders. Don't put them all at the same time. That being said, I'm playing some at 47, and I will play them a little bit lower and build a little bit of an Iris Energy position on this pullback as we kind of flush some of the retail froth out of these end markets. Same concept with ASTS, running a whole bunch. The mini Starlink finally coming down. Pay attention to your levels, right? Down here under 60 is where you would be wanting to do it if you enjoy this stock and looking for a great big back test of a huge level overall. These time frames, look at the monthlies, man. They ran too much, too fast, due for a pullback. Where's all that money going? Well, before I get into where the money's going, VST, I actually like VST. They have very solid earnings. They have a very positive or a very large infrastructure network for providing energy to the data center players because they're going to need it, right? Down here, I'm exploring the possibility of 170 to 160 short puts. I think it's a really attractive level for VST, and you're just looking for the good old monthly pullback that I showed you on so many other big tech names out there in the mix. This company's positioned really well to benefit from the data center build over the next 3-4 years. So down there, swing trades, shares, things of that nature, decent. I'm a decent fan of those positions overall, right? Now, that is where some of the money is leaving. I mean, Constellation as well, right? Huge pop, pulling back. All this is the same trade. It's just energy and data center build outs are just all coming down. They just ran so hard, and now the money is flowing into other aspects of the market that hasn't seen it in a very long time, right? I mean, we could talk about Oscar Health. This one, we talk about it almost every week. This one is still my favorite health insurance player amongst that whole thing. You might remember we sold our call options down here. When it pulled back all the way there, I was saying decent area for some short puts, and now it's just riding. If you have some shares from down here, I don't really see a reason to sell. This is like a multi-year thesis. I mean, we could talk about Lulu, we could talk about Kava, but I'm pretty sure you guys are not really interested with that stuff. You guys want the software plays, right? That are up a ton. Now, these software players, a lot of them, guys, the narrative has always been that AI is going to kill their business. But similar to what we were seeing with Google earlier this year, when it had those same allegations, when Google was reporting earnings, you weren't seeing AI kill their business at all. Their business was doing really well. And arguably Adobe, poor thing, has shown the same thing for the past 3 quarters. They're just beating and not reducing any guidance, right? So when we did this one back in March, I mean, the price is largely the same. Nothing has changed, right? This should be 2025, my mistake for that, but it is the correct numbers. You're sitting at like a 1.35 peg. It's not a commanding valuation at all. And I was saying, listen, if we have some speculation to do, I mean, if you guys are considering buying, I know they're not as sexy, right? But if you guys are considering buying NBIS at the top end of a 90, plus RSI blowout on the daily and weekly timeframes, ridiculously overbought chart, right? NBIS, by the way, another name that I'll be interested in playing, 90s down to 80. I'll be very interested in playing it down there. But if you guys had no problem buying this stuff, I'm talking about all the stuff we just went over, all the way up here, pure FOMO, and you guys are fine with that, saying long-term thesis, Well, I mean, maybe you guys won't have any issues making some small bids on some software companies that are relatively cheaply valued. They've been out of favor sentiment-wise for a very long time, have been establishing key areas of accumulation, and that might be getting a bit of institutional flow as we move into Q4 with some of these companies still down 20% year to date. Just a little bit of thought, right? Same thing for CRM. Not too bad at all, right? Some people will say, well, this move right here is because of their event that they had the other day. Arguably not when it's sector wide, right? This follow through right here has nothing to do with CRM. This is probably institutional money positioning on some of the S&P 500 names that are still down significantly year to date and still having decent valuations, right? At 240, we did it. It was a 1.57 peg with an over 5% free cash flow. You don't find that too often with solid companies that aren't really dying in terms of revenue or EPS growth at all. So maybe also worth a bid for this unloved, destroyed company that's down so much year to date. Other companies can include, names like Atlassian, just down, dead, and out. Companies like ServiceNow. This one held up better than others, but still down, right? This one has crazy nice growth rates as well. It trades a bit expensive though, so you can't give this one the cheap argument, but so many software companies, guys, bit the bullet, Monday.com, all the way down there. So I'm not telling you guys which ones to buy. I'm just saying, pay attention to the whole sector, right? Because even some of the cybersecurity plays, they've been coming alive recently, Sentinel-1, I know it's just one day. Companies that I'm looking at like Rubrik have been coming up a little bit recently, not enough to drive a trend from, but, CrowdStrike off the lows the last couple of days, Palo Alto Network. So maybe software could be the rotation if you're moving things away from hardware and names like Oracle, right? Things of that nature, which have been notably weak in terms of retail buying and in terms of institutional buying. At least the last 4 days have accelerated that. Maybe you want to look into certain aspects of the market that have been unloved, left behind, have decent valuations and decent risk to reward setups. Because at the end of the day, if you're trading, man, it's all about the risk to reward setups, right? I have no problem putting a stop loss on Adobe on my swing trades here and going for the big expansion range, right? I have no problem putting a stop loss on CRM below these lows and going for possible the top end of the expansion range. Those trades make sense. Those trades make a lot of sense. What am I going to do here on NBIS? Just buy this lack of a level here blindly and just say, yeah, I think that's it for the dip, man. I think we're just going to rally from here. Where do I put my stop loss, right? Below these guys? There's not much there other than the Microsoft deal, right? But I mean, I guess you guys know see the point that I'm trying to make. Iris Energy, same thing. I buy it here. But if I'm trading, where do I put the stop loss? Under today's low? They just cracked it in the after hours again. You know what I mean? It's like, where do you put the stop loss on these things? There is no stop loss area because the bulls didn't do anything in terms of setting support on the way up. So these very volatile names, I'll play using short puts and then farm the hell out of covered calls if I'm assigned because they have good volatility. And I know that I'll be getting discounts in excess of 30, 40% from the highs if I get into them, right? But the other names, I'm building positions in them starting kind of now. So that's the rotation analysis that I want to take you guys in. I think that's the most important aspect of the market today. So that being said, that's everything I had for you guys today. Hopefully you guys enjoyed today's action. If you did, consider dropping a like on the video. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new as well. Almost 10,000 subscribers, guys. I don't ask for much, but it's a big milestone for me, man. I've been making these videos for 2 years, and now we're finally at a very large milestone. Still far away from the YouTube plaque. Maybe that'll come one day, but I digress. Thanks so much for the time you spend on the channel and for subscribing. It really means a lot to me. And lastly, if you have any questions, feel free to ask them down below in our, in the comment section, essentially. And in the event that you guys wanted to participate in a trading and investing community of people such as yourself with over 300 other members in there, trading the markets there every day, building long-term portfolios and having a whole bunch of fun in the process, you may consider joining our trading community. In the trading community, you get access to a few things. Number one, you definitely get access to all of my trades in real time, whether those are the wheel trades, the call debit spread trades, the rotation trades, the trades with shares, the leap call options that we've been crushing this year. You guys get access to all of them. You guys can see a lot of these trades that we make in terms of a weekly basis, right? The green check marks are wins. The red little circles are losses. I'm always very transparent. I like to keep my wins frequent and big, and my loss is infrequent and small. Of course, that's the name of the game when we're trading, of course. So you get access to all of those trade types. You also get access to our private morning live streams Monday to Friday for 2 hours, where I trade live, but I also take all your questions on your stocks, your options, and your long-term portfolios. If you can't be there, they're always recorded. You can also ask me all your questions in our chat rooms throughout the day. You also get access to my private video educational section. I have like 20 hours of content, 15, 20 hours in content in there. Technical analysis, how I do it, fundamental analysis, how I do it, how to build a trading account, various trading strategies, call debit spreads, call credits, credit spreads, right? Leap call contracts, how to build a long-term portfolio. So many different educational videos that I won't put on YouTube are in that segment. It's one of our members' favorite segments. And last but not least, as a bonus, you get access to all of my charts, right? Whenever you see support and resistance levels, things of that nature, and earnings breakdowns or fundamental breakdowns, and you just don't want to do them on your own, and you just want to copy them, you can just copy all my charts. It takes like 15 seconds, couple clicks of a button, you get all of my charts and all of my watch lists that I use to trade every single day, just as an added benefit. If any of that sounds good to you, the link to join us in the community is down below in the video description. I hope to see some of you guys in there soon, and if not, I'll see you right back here on the channel. That's it for me. Enjoy the rest of your evening. Have a good day in the markets tomorrow, and I will see you after the close for good old Tesla earnings. Take care and peace.